So it looks like the Fed is changing their tune. It looks like they are going to reduce asset purchases. And in 2022, it looks like they are going to start raising rates. In fact, they are going to raise rates 3 times in 2022. So here's the chairman of the Fed, the Federal Reserve. This is the guy that is in charge of the money printer of the United States. So we're going to hear a little bit of his opening remarks, what he's saying about the economy. And I'm going to add some commentary and, just talk about how I'm going to work with what the Fed is doing and what I'm doing with my investments to make sure we keep on with the trajectory of the portfolio, which is to grow it over time.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the Federal Open Market Committee kept interest rates near zero and updated its assessment of the progress that the economy has made toward the criteria specified in the committee's forward guidance for interest rates.
So what he's just saying right there is they basically keep an interest rate. That's the interest rate that you get on your savings account, or the interest rate that you pay on your mortgage. They're keeping it the same at the moment.
In addition, in light of the strengthening labor market and elevated inflation pressures,
he's saying that because, I don't know why the Federal Reserve, they don't, or any of these people, they don't like to use just regular English. He's basically saying the job market is really good. People can get jobs. And because of that, there's pressure on prices of goods and services. Inflation is going up. So it's costing more for everything. Everything just costs more now.
we decided to speed up the reductions in our asset purchases.
So what he's saying by asset purchases, this is when the Federal Reserve basically creates money, and what they use that money for is they lend that money to governments, which is the U.S. government, states or companies. Okay, during the beginning of COVID, the Federal Reserve basically print a lot of money, and they use that money to give to the government. That's why you're able to get your stimulus check. And they also give a lot of that money to corporations.
As I will explain, economic developments and changes in the outlook warrant this evolution of monetary policy,
okay,
which will continue to provide appropriate support for the economy. Economic activity is on track to expand at a robust pace this year, reflecting progress on vaccinations and the reopening of the economy. Aggregate demand remains very strong, buoyed by fiscal and monetary policy support and the healthy financial positions of households and businesses.
So basically he's saying businesses, they have a lot of money. Households have a lot of money because of all the stimulus checks that everybody got.
The rise in COVID cases in recent weeks, along with the emergence of the Omicron variant, pose risks to the outlook. Notwithstanding the effects of the virus and supply constraints, FOMC participants continue to foresee rapid growth.
So basically, this chart is basically saying that they believe the growth of the economy is going to go higher.
As shown in our summary of economic projections, the median projection for real GDP growth stands at 5.5% this year,
okay,
and 4% next year.
Okay.
Amid improving labor market conditions and very strong demand for workers, the economy has been making rapid progress toward maximum employment.
Okay. So I think I get what he's trying to say here. Basically, the Federal Reserve, right? They have two jobs. So their two main goal is to maintain maximum employment. So that means they make sure most people that are looking for jobs and want to work, they have jobs and they can work. So people that are willing to work and want to work, they have jobs and they can work. So that's on the employment side. The second mandate, the second job, is to make sure that the inflation or interest rate, basically monetary policy, they make sure that's good as well. So what they've worked on over the past maybe 2 years or so is still to make sure there's maximum employment. So people that are looking for jobs are still able to get jobs. So that's one of the aspects that they've worked on. The other aspect that they're going to start working on now is to make sure the inflation rate don't go too high. Inflation meaning the prices of goods and services going up over time. The Federal Reserve, they basically target 2%. They only want the prices of goods or services to go up by 2%. But in reality, I think it's roughly about 2 to 3% that the prices of goods and services go up. Like for rent, for example, people that rent or pay gas, or buy gas and all these things, like it's not 2% that the prices of these things are going up. Your rent is not going up by 2% per year. It's probably like 2 to 3%. And most jobs don't even give you 2 to 3% increase in your income every year. So they're just trying to make sure they get to those two basic economic projections. And they've done a great job with the first one so far, making sure that the economy has, what it needs to be able to employ people, hire people, make sure that employment still keep on going. But because they have a lot of money in the system, now they have to basically cut that out. So that way prices of things will not go sky like crazy high moving forward. So basically that is the big thing that happened this week. The Federal Reserve, they're basically saying that they are going to start working on the inflation side of things, that the monetary policy has been doing well so far in terms of on the employment side. So now they are going to work on the inflation side of things. Here's another great video from Wall Street Journal explaining what I'm trying to say in 4 minutes or so. Of course, links to the video will be in the description if you want to go check out the entire video. I'm just going to show a small part of it so I don't get any copyright issues. I'm just going to show a little bit of it. So
in this market environment, the very mention of one economic term sets the big indexes on edge.
But at this point, the economy is very strong and inflationary pressures are high, and it is therefore appropriate, in my view, to consider wrapping up the taper of our asset purchases, which we actually announced at the November meeting.
Keyword is taper there. Pay close attention to what they mean by taper.
Perhaps a few months sooner.
That's the chairman of the Federal Reserve in late November, foreshadowing that the central bank would speed up tapering, or winding down of the bond buying program it launched in 2020 to help fight the COVID-19 economic crisis. His words sent a shudder through the markets.
Taper.
Tapering.
Tapering.
Taper.
They should be tapering.
And it's easy to see why. The Fed's stimulus has fueled a historic rally that has lifted major indexes far beyond their pre-pandemic highs.
Major moves. The stock market has gone up like almost 100%. Like 50% this year alone is just mad.
So, if the economy is strong, as Powell said, and stimulus has been so good for stock portfolios, why are the markets so worried? Here's Jerome Powell again, this time in July of 2020, amid pandemic shutdowns that had ground the global economy to a halt.
At the Federal Reserve, we remain committed to using our tools to do what we can, and for as long as it takes, to provide some relief and stability.
He was promising, in part, to continue purchasing $80 billion of Treasury bonds and $40 billion of mortgage-backed securities every month to
This part is very important, guys. Let's pay close attention here.
Increase the money supply, encourage lending, and help bring the economy back from the brink. This type of stimulus is called quantitative easing, and it works like this. When the Fed buys securities on the open market, it takes them out of circulation, leaving fewer for everyone else to compete for. With less supply, investors bid up the price of the remaining securities. And as is always the case with bonds, when the price goes up, the yield goes down. So what does it mean for you?
So I'm not going to play the whole entire thing. They do a great job, so I'll leave the link for this video in the description if you want to watch the full video. So with that being said, I would like to start with this information right here. This is the list of the companies, some of the companies that I'm invested in. and how the dividend comes in. Even though some of them are pretty small, but the dividend still come in. I still get my dividend. If you take a look here, we have some companies that are paying, $1 or $2. Some companies that are paying some cents. So companies that are paying some gigantic, some pretty big money as well. So if you take a look at the most recent one that we've had here, we got Home Depot. That was pretty small. MSCI, a lot of the MSCI index I'm investing in, they're all paying. This one's like $4, like $1. This is a massive $11. It's pretty big. And then there's another $20 right here. What is the moral of the story? The moral of the story is I still keep on investing. Regardless of whatever happened in the market, I invest in companies that pay on a regular basis. If you take a look at the month here, for the past month, in the past month, we've earned $100 in dividend right here. $100 in dividend. This is great. Regardless of what's going on in the economy, for me, as a personal finance person, I still go with the belief of live below your means, save your money, and invest in companies that are growing, companies that are making a lot of money. And especially during the times of inflation like this, you have to invest in companies that have pricing power. A lot of, like companies like Dollar General, companies like Dollar Stores and Target and, Walmart. A lot of this company, even recently I made a video on companies that are great inflation hedge, like the tech companies. Investing in the tech companies would be a good investment at this point in time because, those companies have the ability to raise their prices and they can raise it pretty big. And most of the companies or individuals that use their product, they are still going to buy the product regardless of whatever happens. So let's take a quick rundown of how the portfolio has been performing. Okay. If you take one day, which is the last Friday, we're down $75, made 70 cents in dividend, pretty low. And, because look at how much the market has gone down by $3,000 for me in 1 week, but made a $53 dividend income here. And if you take a look at the month, like you've seen, the month my portfolio has gone down by $6,000. Mind you, I still constantly put in money. I put in roughly about $4,300 into the portfolio in the past month. And if we take a look at the past 3 months, we are still up in general $3,000, $232 in dividend right here. This is just in 3 months. So the portfolio is doing very well. Still making very good money. I mean, in 3 months, this has gone to a point where, you can take care of some phone bill for like 6 months. If you have like a cheap phone bill, $30 phone bill, take care of it for a couple of months for you. And this is money that I don't have to work for. I work for my main money. I invest into across these different sectors in different things. And, the portfolio is just printing checks, which is what I love. So in the past year, the portfolio is up $9,000, 18% performance so far this year. Who knows what's going to happen in the last 2 weeks of the year. But the portfolio has generated $659, roughly almost $700 in 2021. Sorry, I mean, like, this thing is doing quite well. I'm glad that I split this way because dividend companies, a lot of them got beat down pretty badly, and a lot of the growth companies got beat down pretty badly as well. But I think over time they're gonna do well. Like, as you guys have seen over the past, coming up 2 years soon that I've had this portfolio has grown 52%. And in the past year, with everything that has happened, it's still grown 18%. Trailing the market a little bit, mainly because of ARK Invest here and my crypto holdings. But I think over time, those ones will even do way better than the markets over 10 years time. They're going to do way better, and I'm just going to keep on investing. The moral of the story is, look at this. For the past year, not only the portfolio generate almost $700 for the past year, we have a situation where the portfolio also grew $9,000 in the past year. So whatever I've been doing, I'm gonna keep on doing it, which is dollar cost averaging. I put roughly $100 to $150 roughly every day into the portfolio. And sometimes when the market goes down, I add in a little bit more. Or this week I've been buying a lot of the tech companies. Let's take a quick look at the transaction here. If we look at the past week here, I've been putting in my regular $100. I put in roughly $100 every day, roughly. And the days that the market goes down a lot, I added a little bit more, 200 there, 250 there, 162 there, an extra 100 there. But roughly I put in $100 every day into the portfolio. So if you take a quick look here, in the past month, some of the companies that haven't been performing well in the passive income section, sectors. A lot of the consumer sector is not doing well. Real estate is not doing well. Finance is not doing well. Telecom, industrial, gaming, and energy and transport here. So the tech sector has been doing very well in the past month. But I'm buying a lot more of the tech sector because I think they're very, very good inflation hedge. I haven't been buying much of the consumer sector. I'm going to be buying a lot more. I'm going to be buying a lot more into the real estate sector, a lot more into the finance sector. A lot of these sectors, after the COVID, I think a lot of them will do well. So I'm going to be buying into them, moving on into the future. So before we move on, I just want to encourage you guys to take a second to hit the subscribe button and to give the video a thumbs up, because it helps promote the channel to other people, other like-minded people that want to see this kind of content, but they don't know that this exists out there. So it really helps push that out to other people. And if you appreciate what I do here, if you appreciate me talking on a regular basis, being fully transparent about how investing work, seeing an example of how it actually work in the real world, because I publish video on a regular basis. At least this dividend section, at least I publish at least 2 to 3 times per month that I do this, that I publish my dividend updates. So if you appreciate me talking, during the good, during the bad times, talking about all the things that I'm doing to grow this portfolio, if you appreciate it, please drop a like on the video. If you're new, give the channel a sub. Trust me, you are not going to regret it over the next 10 to 15 years or so. So if you enjoyed today's video, again, please give the video a like. Appreciate you. Until next time, see you later. Love you all. Bye.